Hey, future homeowners, welcome back. I'm Christina Appleman, and if you're here today, it means you're ready to take a major step towards buying your dream home. I'm talking about getting pre-approved for a mortgage. Whether you're a first-time home buyer or you're just getting back into the market, I'm here to walk you through the pre-approval process step by step. This isn't just paperwork. Getting pre-approved is your ticket to understanding how much house you can afford, showing sellers you're serious, and giving yourself a confidence boost as you enter the exciting world of home buying. So let's get you pre-approved and on your way to getting those keys. First off, what exactly is mortgage pre-approval? Simply put, pre-approval is when a lender reviews your financial information like your credit score, income, and debts, and tells you how much they're willing to lend you. It's based on an in-depth look at your finances, not just an estimate. Why is this so important? Here's the deal. Pre-approval gives you a clear picture of your budget, shows sellers you're a serious buyer, and could even make your offer stand out in competitive markets. Plus, it saves you time by helping you focus only on homes within your price range. What is the difference between a pre-approval and a pre-qualification, aka a pre-qual? A pre-qual is more casual, quick estimate of how much you might be able to afford, but it doesn't carry the same weight as what a pre-approval does. A pre-approval is the real deal. It's like having your mortgage ready to go in the eyes of the seller. Step 1, check that credit score. Your credit score plays a huge role in whether you'll be approved and what interest rate you'll get. The higher your score, the better the terms you're likely to receive. How to check your credit score? You can check your credit score through free services or your bank. Aim for a score of 620 or higher, although FHA loans often accept lower scores. But remember, the higher your score, the better. Besides credit, lenders will look at your debt-to-income ratio, also known as DTI. That's the percentage of your monthly income going towards debt payments. Most lenders prefer your DTI under 43%, so aim to reduce debt if you're above that. Step 2, gather your financial documents. All right, it's time to gather some paperwork. You'll need documents that prove your income, assets, debts, and credit. This includes your W-2s, pay stubs, bank statements, and tax returns. Essentially, anything that gives a full picture of your financial health. Lenders use these documents to verify your income and check that you're financially stable enough to take on a mortgage. The more prepared you are with these documents, the smoother your pre-approval process will be. So some quick tips would be maybe you could create a folder, physical or digital, to organize everything. Being prepared not only saves you time, but also impresses your lender with how serious you are about getting pre-approved. Step 3, now that you have your documents ready, it's time to choose a lender. And here's a tip. Don't always go with the first lender you find. Mortgage rates, fees, and terms vary by lender, so it pays to shop around. There are banks, credit unions, mortgage brokers, and online lenders. Each offers different benefits, so think about what matters most to you. Do you want a lender with local knowledge, or are you looking for the best possible rate? Comparing options could save you thousands in the long run. So how do you compare lenders? Request loan estimates from multiple lenders to compare rates, fees, and terms side by side. Look at your APR, also known as your annual percentage rate, as this includes interest and additional fees, giving you a true picture of what you'll be paying. Step number 4, let's fill out that loan application. Once you've chosen a lender, it's time to officially apply. You'll fill out what's called a Uniform Residential Loan Application, or a URLA, which asks about your employment, income, assets, debts, and credit history. Be thorough and honest in your application. Lenders verify every detail, so make sure your numbers add up. For example, if you're self-employed, be prepared to provide additional documentation like maybe a profit and loss sheet. Many lenders allow you to fill out applications online, making it easy and convenient. But if you're more comfortable with a face-to-face meeting, go for it. This is your chance to ask questions and get a feel for your lender. Step 5, the waiting game. What to expect. Once you submit your application, it goes through underwriting. This is when the lender's team verifies all your information to make sure you're a good candidate for the loan. So how long does this process usually take? This process can take anywhere from a few days to a couple of weeks, depending on the lender and how busy they are. During this time, be patient, but stay in touch with your lender and respond promptly to any requests that they ask. Here's an important tip. Avoid any big financial changes during this time. Don't open up new credit lines, make major purchases, or switch jobs. These changes can impact your credit score, debt-to-income ratio, and possibly affect your approval for the loan. Step 6. Receiving your pre-approval letter. If everything checks out, you'll receive a pre-approval letter from your lender. This letter states the amount you're approved for, the interest rate, and the loan terms. It's basically your ticket to making offers on homes. So why is this valuable? This letter is golden in the home buying process. It shows sellers that you're financially prepared and have a lender willing to back you up. In a competitive market, this can make all the difference. Now, make sure you review the letter carefully. Check the loan amount, rate, and terms to make sure everything aligns with what you discussed. If something seems off, reach out to your lender to clarify. Step 7. Set your budget and start house hunting. Now that you know your loan limit, set a realistic budget. Remember, just because you're pre-approved for a certain amount doesn't mean you have to spend that much. Factor in other costs like property taxes, insurance, and HOA fees. Think long-term. How does this mortgage fit into your financial future? Make sure your monthly payment aligns with your lifestyle goals. Armed with your pre-approval letter and budget, it's time for the fun part. House shopping! You're now a serious buyer ready to make an offer when you find the right home. Here are some common mistakes to avoid during pre-approval. Number 1, don't settle for the first lender. Compare to make sure you're getting the best deal possible. 2, overestimating your budget. Stay within a comfortable budget to avoid being stretched thin. Remember, there's more to homeownership than just the mortgage payment. 3, making big financial changes. We covered this earlier, but it's worth repeating. Don't make any big financial moves during pre-approval that could mess up your financial profile. So let's recap. So to get pre-approved, you want to check your credit, gather your financial documents, shop for a lender, fill out your application, wait for underwriting, receive a pre-approval letter, set your budget, and start shopping. This may sound like a lot, but it's a major step towards owning your own home. Trust me, the effort is worth it. You're building your foundation for your home ownership journey. If you found this video helpful, don't forget to give us a thumbs up, subscribe for more home buying tips, and share it with someone who's starting their own journey. And if you have any questions about getting pre-approved, drop them in the comments below. Thanks for watching, and here's to taking your first step toward your dream home.